Welcome, tēnā koutou. Welcome to everyone joining this call today. My name is Beth Johnson and I lead engagement for the Centre for Sustainable Finance. The Climate Change Commission's annual emissions reduction monitoring report serves as an independent assessment of New Zealand's progress towards its legally mandated emissions budgets and the 2050 net zero target, as established under the Climate Change Response Zero Carbon Amendment Act 2019. These reports evaluate current emissions data and future trends and assess the effectiveness of government policies in reducing greenhouse gas emissions. The Centre for Sustainable Finance is an independently governed charitable trust founded in 2021, which works with partners across the financial system to enable and accelerate capital flows towards sustainability and resilience outcomes across key sectors of the New Zealand economy. The Centre has made submissions to the government on both emissions reductions Plan 1 and 2, with a focus on key enablers for financing emissions reductions in line with the objectives of each of those plans. The Commission's monitoring reports, and especially the matters related to funding and financing the transition to a low emissions economy, are of particular importance to our partners, who are major financial institutions, as well as the New Zealand Government. So the first 20 minutes of today's webinar, 15 or 20 minutes, will provide a high-level briefing aimed at senior executives within our partner organisations. And the following 20 minutes will give a detailed briefing for sustainability and sustainable finance practitioners and technical experts. So if you have any questions throughout the presentation, please type them into the webinar platform and we will try and answer them at the end of each section. So moving on to the next slide, I'm pleased now to welcome Joe Hendy, Chief Executive of the Climate Change Commission, and Rob Carr, Project Director at the Commission. Joe and Rob, thank you so much for being here today, and over to you.
Kia ora koutou, thanks very much for having us. So I'm going to give you a quick high-level overview of our work. And then Rob is going to come in, provide a bit more detail in this first session before we move into that, the more detailed session later. So quickly, who is the Commission? We're an independent, evidence-based expert body. There are 25 equivalent bodies around the globe, and really, we're set up to provide independent advice on climate action and monitor progress. So advice on what is possible and also what's needed to meet the country's climate targets. And the Commission also monitors to make it clear to the public and to the government whether the country is on track for meeting those goals. And as well as providing that kind of clear take on what the evidence is telling us from an impartial point of view, we also give insights into where there's potentially opportunities, where the risks lie, what the challenges are, and what progress we've made. So zooming in a little bit more into what we do on monitoring and why, we provide these yearly snapshots on how the country's tracking. And the point is to build a picture over time. And really, fundamentally, this is about encouraging action and about delivering on the country's commitments. We all have heard that adage, what gets measured gets managed. And the Commission, by doing yearly assessments, provides an early warning system, essentially, which allows the government to course correct if needed, but it also gives people that clear, trusted information. So in that way, it helps build accountability and trust in the system so that we actually deliver. So going right to the upshot of what did we find in this year's report. This is our second monitoring report, and what we have found is the country has made progress. So emissions are starting to come down and we're seeing real action on the ground. We're on track largely for meeting the first emissions budget, which finishes at the end of this year, but beyond that, there are increasing risks that we won't achieve our budgets, and that there's significant risks to achieving the 2050 target. The good news is, though, there are plenty of opportunities to course correct across every sector of the economy. It's reliant, though, on moving quickly, and particularly we've recommended the government moves quickly to make sure the right policies and environment is set up to remove barriers to action. And this is particularly as projects take time from initiation to when they actually start to reduce emissions. So what we do in the next couple of years is going to dictate what's possible in the 2030s. Delay will reduce options and choices and raise costs as a result. And this isn't just about achieving a number, hitting our emissions targets. There is really strong evidence growing globally that how we do it, how well we make this transition can also strengthen the economy. So we're talking about the opportunity to invest in a low-cost, resilient energy system, reduce our exposure to volatile international fossil fuel markets, moving to protect our market access and comparative advantage in a world that's quickly demanding low emissions products as a condition of entry, and ultimately help unlock long-term economic growth, as well as building that better future for our kids. So moving to the bigger picture, and what really stands in the way of acting on the opportunities that we've identified. Well, one of the key things that we've identified playing a role here is policy uncertainty. And we've heard this very consistently from business over the last 5 years, that predictability in the policy sense is incredibly important. It provides that level of assurance that investments won't be undermined, that people are moving in the right direction. But the more uncertainty there is, the more hesitancy, and we're going to underinvest. We're going to have a much harder time of getting to our goals. Now, we can't do much about global uncertainty, but just to note, this is a mega trend and it's not going away. Climate impacts are worse than initially thought, even back in 2018. And as a globe, we haven't done enough yet. Also, there is actually globally strong public will here to do more. A recent survey showed that 89% of people want more climate action, but just don't think that anyone else does. And another recent survey showed that 91% of global CEOs surveyed see the transition as an investment opportunity. So while there is a lot of uncertainty globally at the moment, and while we have the US pulling back, what we're seeing across the other jurisdictions is doubling down. And China in particular is making a very massive play to be the dominant economic sector in that low emissions economy. And this really gets to the nub of the fact that climate action and economic opportunity go hand in hand. So it's also important to note that delivery isn't easy, but there are benefits. And globally, attention is shifting from a real discussion about what can we promise to do to how do we actually deliver it. And this is going beyond just the diplomatic discussions and what country leaders are pledging. It's now a conversation about how do we mobilise at all levels, national, regional, cities, communities, and there is a really strong role for sustainable finance here too. So looking more closely at that role of sustainable finance, what's in our report that can help with this sector? And while the government can't do much to control global volatility, they can do something about policy uncertainty here. Some of the sources that we've heard about that are creating uncertainty are the scrutiny of bank lending practices, review of the climate-related disclosures regime, regulatory change on the table for forestry. So what the Commission has said to government is that they need to address those areas. And what providing predictability looks like is giving good access to good information. It's providing clear and stable signals, regulatory stability, and crucially, supporting a sufficient carbon price that will drive investment. And this will all help support the government's chosen strategy of a market-led, cost-effective transition that is at lower fiscal cost to the Crown. So the opportunities for the government to support sustainable finance involve making sure that they evolve the ETS so it continues to be able to drive the incentive through the economy into the 2030s, making sure that whatever changes that if they do make changes to the climate-related disclosures, the effectiveness is still there, being clear on direction so that banks can provide finance with confidence and look to see how they can leverage emissions incentives offered by large companies and particularly their signals being driven offshore for our producers at home to produce those low emissions products. Right, final slide from me. How does this monitoring report fit in with our other recent work? At the end of last year, we produced a report looking at the 2050 targets and whether the emissions budgets were fit for purpose. So this was essentially kicking the tires on the country's domestic climate goals. And we recommended at that point, it was actually in New Zealand's best interests to tighten those goals. The ball is currently in the government's court right now on that. So the advice we've produced this year is all within the context of our current legislated goals. Earlier in the year, in April, we also gave advice on the settings of the ETS. This is another piece of work we do annually, and it's a very specific piece where what we do is take what the government's stated plan is and to meet the current goals and translate that into ETS settings. And this monitoring report is actually about looking at the government's plan and running the ruler over it. Is it sufficient? Are we on track? Is there course correction needed? So that's the 5-minute overview from me. I'm going to hand to Rob now to go into a bit more detail at a sector level.
Thank you, Jo. So to cover first on the risks that we've assessed, the country is likely to achieve the first emissions reduction budget, which ends this year, which is due to a combination of emission reductions and improvements to how emissions are counted as well. For this budget, the window for policy to make a significant difference is now largely closed, and the remaining risks are largely external ones around dry years and declining gas supply, potential loss of forests, or changes to how emissions are counted. The second emissions budget, which covers 2026 to 2030, can be met, but there are some areas of significant risk. While it's still possible to meet it, current plans are insufficient to meet the third emissions budget. There's a 9 megatonne gap for that budget where action to reduce those emissions hasn't been planned for yet, and a number of areas of significant risk have been identified for that budget. The key areas of risk that we've identified for future budgets are in energy and industry. We've seen risks around electricity generation emissions increase in the last year, which could also flow through to businesses' willingness to invest in electrification. And it's unclear whether planned emission reductions using carbon capture and storage can be realised. There's also a risk around relying on a single sector, with 46% of planned changes in emissions in the third budget coming from carbon removals using forestry. And around the late 2030s, the net emissions cap within the New Zealand Emissions Trading Scheme is expected to reach zero, which could limit the scheme's effectiveness once you get beyond that point. As Jo noted earlier, we highlight that markets need good information, clear signals, and regulatory stability accompanied by a sufficient carbon price in order to drive investment. The risks identified show the importance of allowing a significant buffer when creating emission reduction plans to ensure that budgets can be delivered despite changes outside of government control. And further action is required before the third emissions reduction plan to address these risks and ensure that budgets can be met. Looking ahead to opportunities, It's possible to meet the third emissions budget and the 2050 target while reducing risk for the second emissions budget. In fact, the possible opportunities we've identified go beyond the current budget levels. The main opportunities are in renewable energy, transport, and agriculture. Lower prices for solar, electric vehicles, and batteries could accelerate the shift to an affordable and reliable low emissions energy system. Supporting farmers and growers to use new technology and shift farm practices will increase Aotearoa New Zealand's competitive advantage and could increase the return for the government on the investments that they've made in public research in that space. Supporting private sector and Māori-led climate action can deliver additional emission reductions and wider benefits without significant fiscal costs to the government. Practical steps the government could take to support action in these areas include a considered, well-signalled evolution of the New Zealand Emissions Trading Scheme structure to drive emission reductions, integrated planning for urban development and transport infrastructure and optimising freight movement across road, rail and coastal shipping, and supporting extension and advisory services for farmers while incentivising earlier uptake of new farming practices and technology. Joe mentioned earlier some of the key areas we identified for helping support private sector investment specifically, and Sam Holmes will talk to those in a bit more detail in the second half of this session. Making these changes can support the economy. 70% of Aotearoa New Zealand's export value goes to countries with mandatory climate reporting in place or proposed, and many ways to cut emissions also help communities stay strong and healthy and support the environment. For example, accelerating the transition to clean transport could help reduce air pollution, which damages people's health, and that would save $1.1 billion a year by 2035. Upgrading homes to lift energy efficiency protects households from high costs and poor health. Looking to the next slide. Due to the risks identified, we have included a recommendation in this year's monitoring report setting out how the government can best get back on track. We consider that requires both structural change to the emissions trading scheme and additional targeted policies to support it, with the areas for greatest potential emission reductions being renewable energy, transport, and agriculture. Action is needed urgently, as many of the options that would make a difference to take time to take effect. For example, New Zealand Steel's electric arc furnace is expected to take around 3 years to progress from when it first got funding approval to when it becomes operational. This recommendation reflects that while the third emissions reduction plan is not due until 2029, early action can reduce investment uncertainty and avoid more disruptive measures later and help put the country on track to meet the third emissions budget and the 2050 target. Now that our report is finished, the next step falls to the government. Next slide, please. Thank you. The government have 3 months to respond to the Commission's report to outline what they'll do to address the risks that we've identified. The policy choices sit with them, and this is their opportunity to course correct to ensure that budgets are met. Some of these opportunities we've identified are also ones the private sector could pursue further that could help further emission reductions. You can find out more about our findings and how they relate to you on our website. We have short summaries available for you to get a quick overview of the areas most relevant to you. The main report where you can read all of our findings and a technical annex and supporting spreadsheets for those who need to get into the details. I'm now happy to take any questions that have come through from people.
Thank you very much, Rob and Joe. We just had 2 questions at this stage. If anyone else has any questions to ask, please drop them into the messaging platform now. The first question is, what are the benefits of taking action to reduce emissions?
Thanks, Beth. Yeah, I think we touched on a number of those benefits in the presentation. It's you know, the world is moving fast on creating that low emissions economy, and our trading partners are increasingly looking down the supply chains for where they can get their lowest emissions products from. This is being hugely driven by regulation and offshore, but has a big impact on us, and our competitors are moving fast. So some of the benefits are around shoring up our access to markets and also moving to protect our comparative advantage longer term. More broadly, I mean, we've all got a huge stake in global climate action. if the globe fails to mitigate the worst, then the impacts, the cost of inaction are huge. Much bigger on our economy. So for all of us to be doing what we can to help support global action, I think we all benefit from that in the end. The more we do at home, the more we can help create the economy of the future for us. But also there are the options for other benefits, like Rob was saying, around the health benefits, for example, and benefits of a lower cost energy system. Rob, do you want to add anything to that?
I think the only other thing I'd add is some of the specific technologies coming through can carry real benefits for businesses and consumers as well. So a recent Rewiring Aotearoa report found that the cost and efficiency gains from faster electrification could save consumers and businesses $29 million a day by 2040. We're also seeing, with some of the new technology coming through in the agricultural space, real co-benefits to that. So low methane genetics for sheep could help increase the proportion of the meat that's lean, which could increase profitability for farms. And we're also seeing with technologies like EcoPond, there's potential to reduce leaching of phosphorus and E. coli into our waterways. So there's some real benefits that those technologies can provide just beyond the emission reductions as well.
Thank you. So that leads to the second question, which is considering those opportunities and also the issues that you've identified, is it still possible to achieve the 2050 target?
Yeah, well, that's what's really clear, really clearly comes through our work, is that there is lots of opportunities and pathways there for us available. It just means making some active choices and doing that sooner rather than later. Rob, do you want to add some of the detail there?
Yeah, I think as we sort of showed with the opportunities graph, the opportunities greatly exceed what is possible in the budget periods, and they really sit quite broadly across the economy. So there's opportunities right through from renewable energy, agriculture, and transport, as well as some in the waste sector, to go further and to ensure that we can meet that target. But it does require additional policy action to make sure that can be achieved, and the earlier we do that, the smoother and less disruptive the transition will be.
Great, thanks. Thank you both very much. So there's no more questions. Thank you both very much for your time today. The next portion of the webinar will cover a finance-focused briefing for technical analysts. So I invite the senior managers on the call now to drop off along with Joe, or of course stay on if you wish. And thank you all for your time today, and thanks again, Joe. And a recording of that portion of the webinar will be made available, as well as the next session. So now we're going to welcome Sam Holmes, who is the Principal Analyst at the Commission. Thank you for joining us, Sam, and I'll hand over now to you and Rob.
Thank you. Kia ora koutou. My name's Sam Holmes. I led the cross-cutting areas of analysis within the report. And yeah, I think that includes the funding and finance area. So I'll talk a bit about those detailed findings now. Rob, did you want to add anything else before I start?
Yeah, just to cover off firstly a few aspects around our approach to the report to help set that in context. So for this year's report, we're continuing our methodology that we used last year, and so there's broad consistency in terms of looking at the findings across time. But since our last report, the government's released the second emissions reduction plan, and so we've made some changes to what we're benchmarking against, so that it is assessing against the government's current plan for this year's assessment. And in supporting that, we use data from the New Zealand greenhouse gas inventory, which goes up to the end of 2023, and then we supplement that with other data sources from Stats NZ and others to give us the latest data up to 1st of April for what we've considered for this year's report. Next slide, please. We also separate the analysis for our report in two different ways. So for areas that cut across multiple sectors like funding and finance and the impacts of government's policies, Chapters 3 to 6 outline a qualitative assessment of the government's progress, gaps, risks, and opportunities. Chapter 3, Enabling Systems, includes a specific focus on funding and finance, but there are also other areas within the cross-cutting analysis chapters that are relevant to sustainable finance, like infrastructure and emissions pricing. We also break down the economy into sectors based on how emissions are counted and reduced. And for these, we produce scorecards that assess the adequacy of the government's policy measures to meet its emission reduction plan in each of those areas. And we set those assessments out through chapters 7 and 11 of the report. And one of the assessment criteria in each of those scorecards is whether the government funding and private finance that are planned for is going to be sufficient to achieve the government's emission reduction plan in the area. So Sam will talk through our specifics of both our assessments for funding and finance, as well as what we found relevant for sustainable finance within each of those sector assessments as well. Before we get into that, to cover off emissions pricing. So emissions pricing is something that we consider separately to our assessment for funding and finance because it has broad impacts on emission reduction incentives overall. Pricing emissions influences the behaviour of both producers and consumers by discouraging high emitting activities and rewarding low emission choices. The government has said that it intends to use the New Zealand Emissions Trading Scheme as its main tool to reduce emissions. The second emissions reduction plan states that it prioritises supporting a credible ETS and restoring broader market confidence by providing regulatory predictability and strengthening market governance. Maintaining stability and market confidence for the ETS is important to ensure that the government's emission reduction plan can be met. And we've seen market confidence stabilising recently, but it still remains fragile and is something that there needs to be focus on. Overall, our findings on emissions pricing are that the current structure of the emissions trading scheme is likely to deliver forestry removals and won't provide sufficient incentives for most areas of gross emission reductions. And around the late 2030s, the net emissions cap within the emissions trading scheme is expected to reach zero, limiting the effectiveness beyond that point. If the ETS is to remain a key policy to reduce emissions for future budgets, it needs to be amended to address the challenges of the 2030s. Beginning a process now for a clearly signalled and well-considered evolution of the emissions trading scheme will help to build confidence in the long-term future of the scheme, and addressing future challenges soon will help provide the regulatory predictability that businesses need to invest in emission reductions and the afforestation needed to meet emissions goals. We've also noted that alternative ways to address emissions leakage could better support industrial emitters to reduce emissions at a lower cost to taxpayers than the free allocation of units that we currently do through industrial allocation. And I'll pass over to Sam now to talk in a bit more detail through our findings for funding and finance specifically.
Thank you, Rob. Hi, everybody, again. If we move on to the approach slide, thank you. So, I just wanted to start by noting, we are continuing to develop our approach in this area, and I really wanted to thank those on the call and others who engaged with the Commission as we were developing the analysis in this report. So it was really helpful, helps us ground truth and gather very rich information, and we would like to continue that going forward. So please share ideas you have for how we can develop our analysis further. So this is the approach we followed. So first of all, under funding and finance sources, and we look at three areas: public sector activity, which we expect to be funded by the public sector in general; public support for private sector activity, which could be in the form of subsidies or grants or loans; and then private funding of private sector activity. And that may be accompanied by regulatory incentives or other measures from government. So we don't generally say there's a right or wrong mix across those areas, but we would expect the government to clearly signal what its intention is across those areas, and then put in place measures that are aligned with that. And the other thing we look at is these cross-cutting issues within funding and finance, which puts a different lens on it. So across all sectors, are there frameworks, regulations, coordination or data needs where the government can help? Other groups with financial barriers to action, within society, within sectors, within regions. And then all of that we've talked about so far is in terms of delivering the government's plan. We also look at opportunities to go beyond the government's current level of emissions reduction plans. So next slide, please. So this is where we'll get into some more detail on what we looked at and what we found sector by sector. And you can see more of this in chapters 7 to 11 of the report. So this is a snapshot of the scores, adequacy scores we gave to funding and finance within different sectors and within the outcome areas related to each sector, where you'd expect to see emissions reductions, and then EB2 and EB3 are the second and third emissions budgets. So there's quite a lot of detail on here. We also aggregate these scores indicated by the red, yellow, amber, green ratings with scores in other areas to get to an overall score. And you can see that on page 31 of the report. I'm not going to talk to each one in detail, but I'll highlight some key points. And you can see overall there is quite a lot of orange and yellow on here, indicating that we found a number of areas with moderate to significant risks to funding and finance being available to support the government's planned emissions reductions. So energy and industry first. There's significant investment needed to reach those emissions reductions across electricity generation and electricity transmission distribution networks, and also technologies to support flexible supply and demand. We found there's credible plans to deliver that within the on the generation side, based on the government's approach of putting in place strong regulatory settings and clear price signals to attract private sector funding. And we do see a need for a long-term plan in that area to boost investment certainty. And we'll have another look at this next year after the government's if the government put in place any responses to the current electricity market performance review that's underway. On electricity networks, we saw some risks there because of the scale of investment and the costs of that flowing through to consumer bills, which could create a risk for public license, social license for that investment in the longer term. On the gas network side, slightly different risk here. Since gas supply is declining currently, there's a risk that the costs of maintaining that gas distribution network will be shared across a decreasing customer base. And that creates risks to providing sufficient funding to support that maintenance of that network, as well as some customers being effectively trapped on the network if they can't afford to change their energy technology. On the transport side, so there's a lot of public funding here, which is allocated primarily through the government's National Land Transport Programme, which signals the allocations across different transport modes. And it was positive that we saw in there funding for public transport. There's been a decision on rail-enabled ferries for the Cook Strait, and also funding for coastal shipping and rail more generally. However, we saw some risks as well. So obviously, large transport projects have uncertainty around the cost in reality, and there's some uncertainty over whether there will be sufficient funding to support maintenance of the aging port and rail infrastructure. We also saw some that the funding for active travel within that government allocations is coming under increasing pressure. So that's walking and cycling. On agriculture, as Rob and Joe have already mentioned, there's been positive development with the emissions incentive payment that's come from Fonterra with support from Nestle and Mars. Although this we highlight a risk that incentive on its own won't necessarily provide the level of emissions reduction which is needed under the government's plans. And we've highlighted that, again, there's been investment by the government for many decades in research and development and now commercialisation, early stage commercialisation of agricultural emissions reduction technology through the Ag Emissions Centre and AgriZero joint venture with the private sector. We've highlighted a risk that, as with all science funding, there's uncertainty over the longer term there of the government's contribution, and there's a need to shift as this becomes more of a commercial venture to a high level of private funding. We also highlighted that although there's incentives provided by the ETS to switch land use to forestry, and those are operating, there's a gap in terms of support for switching to other low emissions land uses from livestock farming, such as horticulture, which does require a large capital upfront investment in general. And then on waste, methane is emitted from decaying organic waste in landfills. That can be reduced by either diverting organic waste away from landfills or capturing the gas which is emitted. And we saw risks to the government's plans there. There's a reported $4 billion shortfall in the funding required for infrastructure and services to divert waste. And there was a question about whether there were sufficient incentives in place for private landfill owners to invest in landfill gas capture. On the F-gases side, so F-gases include refrigerant gases, which in cooling systems, air conditioning, and positive finding there that the incentives under the ETS appear to be operating effectively to make sure those gases are captured and destroyed at the end of life. Right, so next slide, please. So that's a canter through the sectoral findings. There's more in the report. This is then the cross-cutting funding and finance findings, which you can find in chapter 6 of the report. And so 6 key findings here, 4 on this slide, 2 on the next. First of all, we found there has been progress in building private sector capability, but gaps remain. So see the progress in terms of the first round of climate statements being made under the climate disclosures regime, which has enabled firms to understand their emissions better, their scope 3 emissions in their supply chain, and the transition risks and opportunities associated with those. So that's all data information which can helpfully underpin investment decisions. We've found there's a risk to SMEs here having the capability to gather the sort of data they need for sustainability-linked finance and for providing the Scope 3 data needed for either New Zealand corporates or for participating in global supply chains. Secondly, Joe has already touched on this, competitive markets and stable regulatory environment are critical for the financial sector to effectively allocate capital, but current focus on banking practices is not necessarily aligned with that. This is an area where we feel the government could send clearer signals over the longer term. The third point is around general barriers which might cause the private sector to underinvest. These are covered in detail in the sector chapters, but in general, these refer to things, important ones in this area include split incentives between tenants and landlords of properties, coordination issues, upfront high capital cost of low emissions investments, where there tends to be a swap for higher capital cost for future operational savings. And also related to technology, the risk of taken by early adopters, especially of new to New Zealand technology. And then number 4, this is where we one of the groups we looked at was Maori businesses and landowners, and there's well documented barriers here to accessing capital. So research shows Maori businesses face approximately 50 basis point premium for accessing loans, and Maori land also faces challenges with if used as collateral. For use as collateral in loans. So that's something we've highlighted would need to be addressed if the Maori economy is going to fully participate in the transition. Okay, next slide, please. So this one is a couple of opportunities we found. First of all, as Joe mentioned earlier, there's a real lag, often a lag between an investment in a low emissions asset and the emissions actually decreasing from that. Secondly, there's also a lag between those emissions declining and the government being able to observe that emissions reduction in its data, which is about 2 years, lagged by about 2 years. So we do see an opportunity here that if some of this data that's being generated on emissions within companies and low emissions investments and finance flows, if some of that can be captured and aggregated in a sensible way, then it gives an opportunity to provide a much more timely view of the progress on the transition to a low emissions economy. And we've suggested that the government look at that as part of its own indicators. And then finally, as already mentioned, there's new incentives in place from Fonterra to support low emissions farmers. We see there's an opportunity for the government to partner with the private sector in this area to increase those rewards for low emissions farmers who uptake some of this technology, which is now coming out of the R&D pipeline. That could help reduce early adopter risk and get a head start on those agricultural emissions. So, that's the cross-cutting areas. And I'll just now talk about a little bit about infrastructure and also impacts and benefits. So, next slide, please. So, I've already talked a little bit about energy and transport infrastructure. We've also looked at the planning system more generally, and in particular its impacts on urban design. So urban design, the layout and of businesses, housing, transport networks within urban areas affects emissions that are produced by those areas over the long term. And that's all informed by the planning system. In our previous advice, we also noted meeting the 2050 target would require a transformation of energy and transport infrastructure, but New Zealand has a historic infrastructure deficit and consenting issues which may limit that. So this is why we looked at this again. We found recent developments offer a sort of mixed picture. So the Fast Track Approvals Act has been passed, obviously, and a number of projects have been consented, approved under that, including renewable energy projects, rapid transit projects and housing developments. However, significant components of the government RM reform programme remain in development, and we haven't been able to make an assessment of how those will affect low emissions development in the longer term. More broadly, within the Fast Track Act and the other regulation around infrastructure, there's no guiding mechanism that we can see to ensure that that portfolio or pipeline of infrastructure will be aligned with a particular emissions path or with climate resilient path. On the urban development side, I noted earlier that there has been public transport investment through the Land Transport Management Fund. However, the government has also given an indication that given direction to councils to increase so-called fare box recovery from public transport. So public transport fares are likely to go up as a result of that, which could reduce patronage over the longer term and the associated emissions reduction. Therefore, if people are driving cars instead of taking public transport. There's decreasing more pressure on active travel funding, and as already mentioned. And another development is changes to the development levy to introduce a development levy and a targeted rates regime. In theory, this might allow councils to use price signals to drive more intensive urban development in particular areas, but it depends at this stage on how those rules are developed and then implemented by councils. So a mixed bag, really, on the urban development side as well. And then final slide for me is about impacts and benefits of reducing emissions. So we look at this firstly because the Climate Change Response Act requires the government to have a strategy in place within its emissions reduction plan to look at mitigating the impacts of emissions reduction policy. And those impacts could be costs or benefits, and they might be differently distributed across different sectors groups within New Zealand. And it's important to manage those, be aware of those impacts and manage them in order to create effective policy and to support social licence, public support for emissions policies. So that's why we look at it. And we looked at it before. Well, these are 4 areas we've looked at in this report. Firstly, we've highlighted the risk of high energy prices after last winter's high wholesale electricity prices. We see that as an ongoing risk, and that the transition to a low emissions economy is an opportunity to build and afford electricity system that provides affordable, reliable, and low emissions energy. And without that, there's an ongoing risk of economic costs to businesses, and of energy poverty within households. And associated with that, there's also a further opportunity remains to improve New Zealand's housing stock, which is a significant driver of energy poverty in its current state. And this is in spite of the government policies in place, so warmer Kiwi homes and the rental housing rules. The evidence suggests there is still significant opportunity for retrofits of housing to improve energy efficiency and create warm, healthy homes. Secondly, we've talked about the benefits from faster electrification. This has already been touched on by Rob and Joe. The other statistic I would highlight here was, again, from rewiring Aotearoa found that 84% of fossil fuel machines within New Zealand could be replaced by currently available, commercially available electric alternatives right now and save costs over their lifetime, which suggests there is some sort of barrier or a number of barriers which might be preventing that opportunity from being realised. And it clearly links to the previous point about affordable, reliable electricity supply. Those things go hand in hand. If I know that electricity supply will be reliable and affordable, then I'm more likely to invest in electrifying my production or other processes. On reliable, affordable transport access, this is obviously not available across New Zealand equally, and something we highlighted as a risk. So shift workers, people in remote communities, low-income households and Māori may face challenges in this area. And we saw that the potential increase in public transport fares created risks here. And finally, on forestry and land use change, we saw that the government's putting in place the regulations to limit some conversion of some land use classes into forestry. We haven't assessed the impact of that because it wasn't fully fleshed out at the point we finalised the report. However, we do see that there's an opportunity for stronger policy coordination here on the impacts of land use change, and that could deliver economic, social and environmental benefits and give rural communities a stronger base to act on climate. The other thing we noted was that prioritising gross emissions reductions across sectors would help to limit the reliance on afforestation and removals through forests, and that could help alleviate some of these trade-offs between different land uses. And that's it from me. So thank you. I'll pass back to you, Beth.
Okay, great. Thank you so much for taking us through that, Sam. We've got time for a couple of questions, and I have one that's come in here. The question is, anecdotally, we hear from businesses that they're dropping ambition due to that policy uncertainty that we've spoken about today. The question is, how specific can the Climate Change Commission get in recommending specific policy signals?
Certainly we've heard something similar around the impacts of that uncertainty, and we've sought to highlight within the report the importance of policy stability and giving clear market signals, and also those sort of providing certainty over the long term for businesses to have the confidence to invest. The role of the Commission is not to develop specific policies. That sits with the government itself, but we do have a role in providing advice on policy direction. So what you'll usually see is us identifying the key areas of risk and opportunity, and we might give examples of policies that the government could use to fix that issue, but we won't necessarily say, you must implement specifically this policy. That sits with the government to do that kind of detailed policy development in consultation with the sectors affected, and make sure that that's implemented in a cohesive way. Within this report, we've given one overall recommendation which highlights the need to strengthen the emissions trading scheme and to put in some additional targeted policies in place within those areas of greatest opportunity. But we also, within the report, have areas flagged as areas for attention. So there's about 5 in each chapter that highlight the highest priority areas that we've identified where the government could take policy steps to address key risks or key opportunities. And so those are a really good place to look for more specificity about what the actual policy changes should be. So we highlight those within the opening bullets in each chapter, and they're explained in more detail at the end of each chapter. And you can also see a list of all of them at the end of the findings chapter in chapter 2.
Thanks, Rob. That's clear. The other question that we have had in is, how does the Emissions Reduction Monitoring Report consider the Climate Change Commission's previous advice to revise the emissions budget?
So our assessment has to be against the current budgets, but it provides useful context for doing our assessment. The work that we did last year identified that improvements to how emissions are counted, as well as forests being planted at a greater rate than expected prior to the budgets coming into effect, meant that the budgets are actually easier to achieve than was intended when they were first set. And so we recommended updating those to bring them in line. The government has till the end of this year to make a decision on that, and we don't know what the outcome of that will be yet. And so our monitoring at this stage is still against the current budgets and targets, but that advice shows the extent of what is possible for New Zealand to do, and so that's helped inform our assessment of where those opportunities are for this year's assessment as well.
Right, thank you. That's all the questions we've had today, so we'll end it there. So thank you again so much to everyone from your team, and Rob and Sam for your time today, and thank you to everyone who has joined the call. If anyone does have any further questions, please do reach out to the centre at the email address shown on the final slide, and we can come back to you on that. And a recording of this event will be available on our website in the coming days. Thank you very much. Ngā mihi.